Welcome to our comprehensive guide on managing financial risks in international business. As companies expand across borders, they encounter a variety of new challenges that can impact their bottom line. From fluctuating currencies to political instability, understanding these risks is crucial for sustainable growth. In this video, we'll explore the most common financial risks faced by international businesses and provide practical strategies to mitigate them. Whether you're a seasoned executive or just starting to explore global markets, this series will equip you with the knowledge needed to navigate the complex world of international finance. Let's begin by identifying the key types of financial risks you might encounter. One of the most significant risks in international business is currency exchange risk. When dealing with multiple currencies, fluctuations in exchange rates can greatly affect profits and costs. Imagine signing a contract in euros, only to find that the dollar weakens by the time payment is due. This can lead to unexpected losses or gains, making financial planning more complex. Companies must monitor currency trends and consider using financial instruments like forward contracts or options to hedge against unfavorable movements. By proactively managing currency risk, businesses can protect their margins and ensure more predictable financial outcomes. Interest rate changes can have a profound impact on international business operations. When borrowing or investing across borders, companies are exposed to different interest rate environments. A sudden increase in rates can raise the cost of financing, while a decrease might reduce investment returns. Managing this risk requires careful analysis of global economic trends and the use of interest rate swaps or other derivatives. By understanding how interest rates affect their international transactions, businesses can make more informed decisions and avoid unpleasant surprises. Credit risk arises when a foreign buyer or partner fails to fulfill their payment obligations. This is especially common in international trade, where legal systems and business practices vary widely. To manage credit risk, companies often rely on credit insurance, letters of credit, or thorough due diligence before entering agreements. Establishing clear payment terms and maintaining strong relationships with trusted partners can also reduce exposure. By taking these steps, businesses can safeguard their cash flow and minimize the risk of bad debts. Operating in foreign markets exposes companies to political and regulatory risks. Changes in government policies, trade restrictions, or sudden regulatory shifts can disrupt business operations and financial planning. For example, a new tariff or export ban can increase costs or limit market access. To manage these risks, businesses should stay informed about local developments, engage with legal experts, and diversify their markets when possible. Building flexibility into contracts and supply chains also helps companies adapt quickly to changing environments. Operational risks refer to the potential for losses due to failed processes, systems, or external events. In international business, these risks can include supply chain disruptions, technology failures, or cultural misunderstandings. Companies must develop robust risk management frameworks, invest in reliable technology, and train staff to handle cross-cultural challenges. By strengthening internal controls and contingency plans, businesses can minimize operational disruptions and maintain smooth global operations. Liquidity risk arises when a company cannot meet its short-term financial obligations. In international business, this can be caused by delayed payments, currency controls, or unexpected expenses. To manage liquidity risk, companies should maintain adequate cash reserves, monitor cash flows closely, and establish lines of credit with global banks. Regular financial forecasting and scenario planning can also help businesses anticipate and address liquidity challenges before they become critical. Country risk refers to the potential for losses due to events in a specific country, such as economic downturns, political unrest, or natural disasters. Assessing country risk involves analyzing economic indicators, political stability, and the legal environment. Many companies use specialized country risk reports or partner with risk assessment firms to stay informed. By understanding the unique risks of each market, businesses can make better decisions about where and how to invest. Global supply chains are complex and often vulnerable to disruptions. Natural disasters, political events, or logistical failures can delay shipments and increase costs. To reduce supply chain risk, companies should diversify suppliers, build inventory buffers, and use technology to track shipments in real time. Establishing strong relationships with logistics partners and regularly reviewing supply chain strategies can further enhance resilience. International businesses are increasingly targeted by fraud and cyber attacks. Hackers may attempt to steal sensitive financial data or disrupt operations. To protect against these threats, companies must implement strong cybersecurity measures, conduct regular audits, and train employees to recognize suspicious activity. Investing in advanced security technologies and establishing clear protocols for incident response can significantly reduce the risk of financial loss due to cybercrime. Investing in foreign assets or companies introduces additional risks, such as expropriation, currency controls, or changes in investment laws. Companies must carefully evaluate the legal and economic environment before committing capital abroad. Diversifying investments across multiple countries and sectors can help spread risk. Additionally, partnering with local experts and legal advisors ensures compliance with local regulations and reduces the likelihood of costly mistakes. International businesses face complex tax regulations and compliance requirements in each country they operate. Failure to comply can result in fines, penalties, or reputational damage. To manage these risks, companies should work with experienced tax advisors, stay updated on regulatory changes, and implement robust compliance programs. Regular audits and transparent reporting practices also help ensure that businesses meet their obligations and avoid costly surprises. Transfer pricing refers to the pricing of goods, services, or intellectual property transferred between related entities in different countries. Improper transfer pricing can lead to tax disputes and financial penalties. To manage this risk, companies must document their transfer pricing policies, ensure they are consistent with international guidelines, and regularly review their practices. Working closely with tax professionals and maintaining clear records can help avoid regulatory issues. Repatriating profits from foreign subsidiaries can be challenging due to currency controls, taxes, or regulatory restrictions. Companies must plan their profit repatriation strategies carefully to minimize costs and ensure compliance. This may involve using intercompany loans, dividends, or royalty payments. Consulting with financial and legal experts can help businesses navigate the complexities of moving money across borders while maintaining tax efficiency. Foreign exchange exposure can impact both revenues and expenses. Companies can manage this risk by matching currency inflows and outflows, using natural hedges, or entering into forward contracts. Regularly reviewing currency positions and adjusting strategies as market conditions change is essential. By actively managing foreign exchange exposure, businesses can stabilize their financial results and reduce uncertainty. Hedging is a key tool for managing financial risks in international business. Companies use various instruments, such as forwards, options, and swaps, to protect against adverse movements in currencies, interest rates, or commodity prices. Developing a comprehensive hedging policy and working with experienced financial advisors can help businesses choose the right strategies for their needs. Regularly monitoring hedge effectiveness ensures that risk management goals are being met. Insurance plays a vital role in managing international business risks. Companies can purchase policies to cover credit risk, political risk, or supply chain disruptions. Working with global insurers and customizing coverage to specific needs helps ensure adequate protection. Regularly reviewing insurance policies and updating them as business activities evolve is also important for maintaining effective risk management. Financial institutions, such as banks and export credit agencies, offer a range of services to help manage international risks. These include trade finance, currency hedging, and credit guarantees. Building strong relationships with financial partners can provide access to valuable expertise and resources. By leveraging the support of financial institutions, companies can enhance their risk management capabilities and expand confidently into new markets. Conducting thorough due diligence is essential before entering any international market or partnership. This process involves evaluating the financial health, reputation, and legal standing of potential partners or investments. By identifying potential risks early, companies can avoid costly mistakes and make more informed decisions. Due diligence should be an ongoing process, with regular reviews as circumstances change. Strong risk management culture is the foundation of successful international business. This means encouraging employees at all levels to identify, report, and address risks proactively. Providing regular training, clear policies, and open communication channels helps embed risk awareness into daily operations. When everyone understands their role in managing risk, the organization becomes more resilient and adaptable. Scenario planning involves anticipating possible future events and developing strategies to address them. In international business, this might include preparing for currency crises, political upheaval, or supply chain disruptions. By considering a range of scenarios, companies can create flexible plans that allow them to respond quickly and effectively to unexpected challenges. Regular scenario exercises keep teams prepared and improve decision-making under uncertainty. Technology is transforming how companies manage financial risks in international business. Advanced analytics, real-time monitoring, and automated reporting tools enable faster and more accurate risk assessment. Investing in the right technology can help businesses identify emerging threats, streamline compliance, and improve decision-making. Staying updated with technological advancements ensures that risk management practices remain effective and efficient. Effective communication is essential in international business, but cultural differences can lead to misunderstandings and mistakes. Misinterpreted messages or differing business etiquette can damage relationships and increase risk. Companies should invest in cross-cultural training, hire local experts, and encourage open dialogue to bridge communication gaps. By fostering cultural awareness, businesses can build stronger partnerships and reduce the risk of costly error. Legal disputes can arise from contract disagreements, regulatory issues, or intellectual property concerns. International arbitration offers a way to resolve conflicts outside of local courts, providing a neutral forum for both parties. Companies should include arbitration clauses in contracts and work with experienced legal advisors to navigate disputes. Proactive legal planning can help avoid lengthy and expensive litigation. Environmental and social risks are increasingly important in international business. Issues such as climate change, labor practices, and community relations can affect a company's reputation and financial performance. Businesses should conduct environmental and social impact assessments, engage with stakeholders, and adopt sustainable practices. By addressing these risks proactively, companies can build trust and ensure long-term success. Joint ventures can offer access to new markets and resources, but they also introduce unique risks. Differences in management styles, objectives, or cultural norms can create conflicts. To manage these risks, companies should establish clear governance structures, define roles and responsibilities, and maintain open communication. Regular performance reviews and alignment of goals help ensure the success of joint ventures. Exporting and importing goods exposes companies to a range of risks, including customs delays, regulatory changes, and quality issues. To manage these risks, businesses should work with experienced logistics partners, stay updated on trade regulations, and implement quality control measures. Diversifying shipping routes and maintaining strong documentation can also help minimize disruption. Efficient working capital management is essential for international businesses. Delays in receivables, inventory buildup, or payment terms can strain cash flow. Companies should monitor working capital metrics, negotiate favorable terms with suppliers and customers, and use financing solutions like factoring. By optimizing working capital, businesses can maintain liquidity and support growth. Accurate documentation is vital for managing financial risks in international business. Proper records support compliance, facilitate audits, and provide evidence in case of disputes. Companies should implement standardized documentation processes, use digital tools for record keeping, and regularly review their records for accuracy. Good documentation practices help ensure transparency and reduce the risk of errors. Internal audits play a crucial role in identifying and mitigating financial risks. Regular audits help ensure compliance with policies, detect fraud, and improve internal controls. Companies should establish an independent audit function, schedule audits regularly, and act promptly on findings. A strong audit process enhances transparency and supports effective risk management. Forecasting cash flow is essential for anticipating financial needs and avoiding liquidity problems. In international business, this involves accounting for currency fluctuations, payment delays, and cross-border transactions. Companies should use robust forecasting models, update projections regularly, and incorporate scenario analysis. Accurate cash flow forecasting enables better decision-making and reduces the risk of financial shortfall. Counterparty risk arises when the other party in a transaction fails to meet their obligations. In international business, this risk is heightened by distance, legal differences, and limited information. Companies should assess the creditworthiness of counterparties, use secure payment methods, and consider guarantees or collateral. By managing counterparty risk, businesses can protect themselves from unexpected losses. Compliance programs are essential for managing regulatory and legal risks in international business. These programs establish policies, procedures, and training to ensure adherence to laws and regulations. Regular monitoring and reporting help identify potential issues early. By fostering a culture of compliance, companies can reduce the risk of fines, penalties, and reputational damage. Partnering with local businesses or advisors can help international companies navigate unfamiliar markets and manage risks. Local partners provide valuable insights into regulations, culture, and market dynamics. Building strong partnerships requires trust, clear agreements, and ongoing communication. By leveraging local expertise, companies can reduce risk and increase their chances of success. Staying informed about global economic, political, and technological trends is vital for managing financial risks. Companies should regularly review market reports, attend industry events, and engage with experts. By monitoring trends, businesses can anticipate changes, adapt strategies, and seize new opportunities while minimizing risk. Crisis management planning prepares companies to respond effectively to unexpected events, such as natural disasters, political unrest, or cyber attacks. A good crisis plan includes clear roles, communication protocols, and recovery strategies. Regular drills and updates ensure that teams are ready to act quickly. Effective crisis management minimizes losses and supports business continuity. Leadership plays a critical role in setting the tone for risk management. Senior executives must prioritize risk awareness, allocate resources, and lead by example. Regular communication from leadership about risk policies and expectations helps embed risk management into the company culture. When leaders are actively involved, risk management becomes a shared responsibility across the organization. Risk management is an ongoing process that requires continuous improvement. Companies should regularly review their risk management practices, learn from past experiences, and adapt to new challenges. Encouraging feedback from employees and stakeholders helps identify areas for enhancement. By fostering a culture of continuous improvement, businesses can stay ahead of emerging risks. Ethical behavior is essential for managing financial risks and maintaining a good reputation in international business. Companies should establish clear ethical guidelines, provide training, and enforce standards consistently. Acting with integrity builds trust with partners, customers, and regulators, reducing the risk of legal or financial problems. Transparent reporting is key to effective risk management. Companies should provide clear, accurate, and timely information to stakeholders about financial risks and mitigation efforts. Regular reporting builds trust and enables better decision-making. Using standardized reporting frameworks and digital tools can enhance transparency and efficiency. International regulations are constantly evolving, and companies must adapt quickly to stay compliant. This requires monitoring regulatory developments, updating policies, and training staff. Working with legal advisors and industry associations can help businesses anticipate changes and respond effectively. Staying agile in the face of regulatory change reduces risk and supports long-term success. Benchmarking against industry best practices helps companies identify gaps in their risk management strategies. By comparing processes, policies, and outcomes with leading organizations, businesses can adopt proven approaches and improve performance. Regular benchmarking ensures that risk management remains effective and aligned with industry standards. Employee training is a cornerstone of effective risk management. Regular training programs ensure that staff understand policies, recognize risks, and know how to respond. Tailoring training to different roles and regions enhances relevance and impact. Investing in ongoing education builds a knowledgeable workforce that can identify and address risks proactively. Data-driven risk analysis enables companies to identify patterns, predict trends, and make informed decisions. Collecting and analyzing data from multiple sources such as market reports, financial statements, and operational metrics provides a comprehensive view of risk. Investing in data analytics tools and expertise enhances the accuracy and effectiveness of risk management. Summary: managing financial risks in international business requires a proactive and comprehensive approach. By understanding the various types of risks, implementing robust management strategies, and fostering a culture of risk awareness, companies can thrive in the global marketplace. Remember, the key to success lies in preparation, adaptability, and continuous improvement. Thank you for joining us on this journey to mastering financial risk management abroad.